The European Central Bank is sounding an alarm, and it has nothing to do with interest rates. The ECB has issued a formal warning that climate change poses a significant and growing threat to global financial stability. The message is pointed. This is not just an environmental problem, it is an economic one. The bank identifies two main channels of risk. The first is physical risk, extreme weather events, rising temperatures, and the long-run damage they do to agriculture, infrastructure, and energy systems. The second is transition risk, the economic disruption that can come as the world moves away from fossil fuels. Both, the ECB argues, have the potential to destabilize financial markets. The timing of the warning is worth noting. Equity markets have been climbing. Investors appear confident in near-term corporate earnings and economic resilience. But the ECB is pointing to something further out. The gap between what markets are pricing in today and the longer-term costs that may not yet be fully reflected in asset prices. That gap matters to central bankers for a specific reason. Severe weather events and climate-related supply disruptions can push prices higher, which makes the ECB's core job, keeping inflation under control, harder. A disorderly shift to cleaner energy could produce sudden economic shocks that ripple across global markets. Either scenario complicates monetary policy. The ECB is not making this argument alone. The International Monetary Fund, the Bank for International Settlements, and other major institutions have published research in recent years making a similar case, that climate risk is underappreciated in financial markets. Regulators across Europe have already begun requiring banks and insurers to assess and disclose their exposure to climate-related financial risks. What is the practical implication for investors? Major institutions are increasingly treating climate risk as a financial variable, not just a political or environmental one. Regulators are moving toward mandatory disclosure. That means more information, eventually, about how exposed individual companies and financial institutions actually are to these risks. The core tension here is a familiar one in finance. Short-term market conditions and long-term structural risks can diverge for extended periods. Investors can, and often do, look past slow-building risks while chasing near-term returns. But central banks and international institutions have a longer time horizon, and they are consistently signaling that the divergence between today's market optimism and tomorrow's climate-related costs will not last indefinitely. The practical takeaway is this: watch how quickly regulators and major institutions move to force climate risk into standard financial disclosures. That is the mechanism most likely to close the gap between what markets are pricing today and what the ECB is warning about now. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.